Imagine waking up every month with a reliable stream of income generated effortlessly from the stock market. No constant trading, no need to monitor the markets every day, just a steady flow of cash hitting your account. Sounds too good to be true. Not with Dividend ETFs. In today's video, we'll break down the top dividend ETFs for building monthly income, compare some heavy hitters like Vanguard's VO and SCD, and help you decide which is right for you. Welcome to Finance in Depth, where we simplify finance so you can maximize your future. Introduction to Dividend ETFs. Dividend ETFs have become one of the most popular ways for investors to build a stable income stream. But why ETFs? Well, ETFs, or exchange-traded funds, bundle together various stocks, bonds, or assets. When you invest in a dividend-focused ETF, you're essentially buying into a portfolio that's designed to pay out dividends regularly, which can be perfect for those seeking monthly income. What to look for in a dividend ETF? Not all dividend ETFs are created equal. When choosing the best dividend ETF for income, here are a few key factors to consider. Dividend yield. This is the annual dividend income you can expect, expressed as a percentage of the ETF's share price. Higher yield sounds attractive, but remember it's often a trade-off with risk. Expense ratio. This is the fee you'll pay for managing the ETF. Lower is usually better, as high fees can erode your returns over time. Payout frequency. Some ETFs pay dividends monthly, others quarterly. For monthly income, you'll want an ETF with more frequent payouts. Portfolio composition. What sectors and companies are in the ETF? Some focus on dividend-rich sectors like real estate or utilities, while others may balance income with growth. Keeping these points in mind will help you choose an ETF that aligns with your income goals and risk tolerance. One. Vanguard S&P 500 ETF VOO. Let's start with one of the most popular ETFs on the market, the Vanguard S&P 500 ETF, or VOO. This ETF mirrors the S&P 500 index, providing exposure to 500 of the largest companies in the United States, including big names like Apple, Microsoft, and Amazon. Dividend yield. VOO's yield isn't the highest, typically around 1.5 to 2%. However, it makes up for it with steady growth potential. Expense ratio. VOO boasts an incredibly low expense ratio of just 0.03%. This makes it a very cost-effective option for long-term investors. Payout frequency. It's a quarterly paying ETF, meaning you won't get monthly dividends, but it's still a reliable choice for consistent, albeit less frequent income. Pros. VOO's low cost, high liquidity, and diversified portfolio make it a solid choice for stable income and growth. Cons. The yield may be lower than other dividend-specific ETFs, so it might not be the best option if you need higher cash flow now. 2. LMP Capital and Income Fund, SCD. If you're looking for a higher yield, then the LMP Capital and Income Fund, or SCD, might catch your eye. Unlike VOO, SCD focuses on a mixed portfolio of dividend-paying stocks and high-yield bonds, targeting a high income rather than growth. Dividend yield. SCD's yield is significantly higher, often above 7%. This makes it attractive for those who prioritize income. Expense ratio. SCD's expense ratio is around 1.4%, higher than VOO, but often typical of funds with more active management. Payout frequency. SCD provides quarterly dividends, but due to its high yield, those payouts tend to be substantial. Pros. With a higher yield, SCD is ideal for income-oriented investors who want more cash flow from their ETF investments. Cons. The higher expense ratio and reliance on bonds may make it riskier, especially in times of market volatility or economic downturn. 3. iShares Select Dividend ETF DVY. Next on the list is iShares Select Dividend ETF DVY. This ETF is geared towards stable, high-yield companies, particularly in sectors known for dividends like utilities and financials. Dividend yield. DVY has a yield in the 3 to 4% range, providing a nice balance between yield and growth. Expense ratio. With an expense ratio of 0.38%, DVY is relatively affordable for a high-yield option. Payout frequency. It pays dividends quarterly, so while you won't see monthly income, DVY offers good stability and predictable payments. Pros. DVY's sector-focused approach allows for exposure to dividend-heavy industries, making it attractive for investors who want income with some stability. Cons. Its sector concentration can sometimes increase risk, especially if certain industries experience downturns. 4. Global X Super Dividend ETF, SDIV. For those looking for even higher yields and global exposure, there's the Global X Super Dividend ETF, SDIV. This ETF tracks high dividend yield companies from around the world, diversifying geographically. Dividend yield. SDIV typically offers a yield above 7%, which is one of the highest available among ETFs. Expense ratio. Its expense ratio is 0.59%, which is higher than the others we've discussed, but can be justified given its international diversification. Payout frequency. Unlike the other ETFs, SDIV actually pays dividends monthly, making it particularly attractive for investors seeking steady cash flow. Pros. SDIV's high yield and monthly payout frequency make it ideal for income-focused investors. Cons. Its high yield comes with risk. With exposure to volatile international markets, SDIV might experience more dramatic price swings. Which ETF is right for you? Each of these ETFs has unique characteristics, so which one is right for you? Here's a quick summary to help you decide. VO is perfect if you want stable, low-cost exposure to the entire U.S. market, with modest income and solid growth potential. SCD works best for high-yield-seeking investors who don't mind a higher expense ratio and are comfortable with some bond exposure. DVY provides balanced income with a focus on dividend-heavy sectors for those who want decent yields and stability. SDIV suits income-focused investors who want monthly payouts and aren't afraid of higher risk due to international exposure. The right choice depends on your risk tolerance, income needs, and investment horizon. Tips for building monthly income with dividend ETFs. Once you choose an ETF or a mix of ETFs, here are some tips for maximizing your monthly income. Reinvest dividends. If you don't need the income immediately, consider reinvesting dividends. This can boost your total returns and compound your wealth over time. Diversify. A blend of high-yield and growth-focused ETFs can balance out income and risk, ensuring you're not overly dependent on one sector or geography. Monitor expenses. Be mindful of expense ratios. They may seem small, but high fees can impact your long-term returns, especially with income-focused investments. So, whether you're looking to build a passive income stream or secure your financial future, dividend ETFs can be a powerful tool. Remember to weigh each ETF's yield, expense, and payout structure carefully, and make sure it aligns with your goals. If you found this breakdown helpful, give us a thumbs up, subscribe to Finance in Depth for more finance insights, and hit the bell icon so you never miss an update. Thanks for watching, and here's to smart investing.